Thank you all for taking time out and being here with us this meeting. This is the Sunday Time Business Club monthly meeting. And first of all, let me thank you, Mr. Tyagaraja and Mr. Deshal Dimel for taking time out and coming here to share their thoughts on today's subject. As you all know, this time around, we decided to conduct the meeting on the foreign currency uh, matters. What we have really thought, that is something what is important at this moment because everyone basically quite interested about the subject. That is one of the main reasons we thought to conduct the meeting on this subject. And first of all, let me outline the today's session. So we will, soon after my small note, I will pass down to the Faisal. Faisal will take over the rest of the day's proceeding. And Faisal will elaborate how it progressed today's sessions. But before that, I would really like to remind you all to keep your speakers mute as and when you know you want to raise a question, so make your opinions. Of course you can unmute and then you can join actively, and other than that, actually soon after the two presenters speech, basically we will open our forum for Q&A sessions. In that sessions, actually we would really like to invite all of you all to, if you have any questions, so you to use the chat box and post your questions. So Faisal is our moderator and he will take up all these questions and we will put that across to the respective speakers. Once again, thank you all for taking time out coming here for this meeting, and hope today's session will be very fruitful session. And thank you so much. And it's over to you, Faisal. Thank you, Faisal.
Thank you, Sampath. Thank you. I'm Faisal, the patron of the club. My tag on the screen is news, so my name is not there. But taking on from what Sampath said, I would like to thank our speakers today for joining us, and they are two eminent personalities, Mr. Rajendra Tyagaraja and Mr. Desha Dimel. Mr. Tyagaraja is a veteran in the banking sector and has been at the helm of HNB, NDB, and Cargills, and has a wide grasp of banking matters. Mr. Deshadi Mail is an economist who is currently attached director at Verite Research, but he has also a corporate background, having been and still being on boards of several listed companies. Welcome to both of you all to today's discussion. Today's discussion is a very relevant topic for, for example, it was this morning that the central bank had to send out a statement saying that they had not issued a circular to banks to devalue the rupee and to sort of to comfort the market. But there is a lot of things happening in the forex market. You know, there are three levels I see. One is the central bank pegged rupee value at 200 rupees, 202. Then bank to bank seem to be trading at 210 to the dollar, and in the black market, in the money exchange market, the dollar seems to be trading at 230, 240, and even more. So this is a crisis, and our reserves are down to just $2+ billion after we paid a $1 billion ISB. Situation is very critical. The speakers will have 10 to 15 minutes to talk on how banks are handling the crisis and the economic perspective. But firstly, I would like to invite our own Sunday Time Business Club member Shankar, who's an importer of fabrics, who will give us a short perspective of the challenges that he's facing in opening LCs and trying to get dollars from the banks. Like Sampath said, the questions can come through the chat box. And we would prefer questions coming on the chat box rather than this unmuting and speaking, because sometimes there are disturbances. But firstly, to kick off this discussion, I'll ask Shankar to say a few words. Shankar, over to you.
Yeah, thanks. Thanks, Faisal. So thank you, Faisal and the EXCO, for giving me an opportunity to share my views on the current dollar crisis from an importer's perspective. So basically importing fabrics. So we normally import fabrics on DP terms all the while, and so when the documents come into the bank, we settle the bill on the respective dollar rate on that day. So now, after this crisis coming in, so we have not, it has been not possible, and because it has been shortage of dollars in the banks. So with this, most of the importers, of course, then without clearing the goods are still lying in the port. So we have to pay a lot of damages and port charges and all that. So that is, even some bills are there even for more than 2 months now. So that is still there. And so when the document comes into the bank with our regular banks that we deal with, so banks, since they don't have the dollars, they also tell us to move into another bank. So then, which is not possible because we've been banking with these banks for a long time. So even the other banks also, then they will find it difficult to give us the necessary dollars. And so that is also an issue. And we also have, most of the importers have brought down the goods on DA terms on open account, like more than 6 months to about 8 months ago. Because there was a time when the government wanted us to bring it on credit terms, not because of the dollar shortage. So then all that bills are also now due, which was brought before 6 to 1 or 8 months before. So that the bills are still there to be settled again. That is also there. And now what we do is to avoid the demurrage and port charges, and with the goodwill that we have with fewer of our suppliers, now we also try to bring the goods on DA 90 days to 180 days, where we don't have any other option rather than to bring in on credit terms. So again, importers bringing in this will again get into trouble after the 180 days, when then the banks will not have, or we really don't know. So after 180 days, then if there are no dollars, and the dollar rate also might increase. And even compared to last week, I think even today, we were just, they were quoting around 213 on a dollar. So last week it was about 203. So that is also another issue. So when these are the main issues, these are the main issues that we have right now. But we really don't know, but the seriousness, of course, depends from trade to trade. But we really don't know as to how when it will come to normalcy, or maybe when it will return to normal. We really don't know. Thank you, Faisal.
Thank you, Shankar, for that brief description of the crisis that importers are facing, first-hand information. I'll now move on to Mr. Tyagaraja to speak about how banks, from a banking perspective, what are the challenges?
Thanks, Faisal. I will, folks, thank you for inviting me and giving me the opportunity. I am no longer involved in active banking, so I can still afford to say what I want to say. But I'm actually going to be objective. I'm not going to criticize any authority on this. Just to put things into a bit of perspective, right? If we, as to why we are in this situation from a general perspective, as I see it as a banker, and then look at maybe 4 or 5 issues or trends which are currently taking place amongst banks, which may be contributing to this issue, right? So if we really look at what happened in July, the government settled that 1 billion of an ISB, which was, I think, anyhow factored by the markets, and of which only 700 million went outside the country. About 300 million was settled for bondholders within the country. Now, with that, the situation is down. The reserves are at about 2.8 billion, I believe, which is just over 1.7 months of imports. Now, in that context, even though they settled it on time, the international rating agencies have seen it fit to downgrade us that downgrading, I think, was on the cards. We have had successive, Deshar will correct me when he talks, if he has to. I think we had successive downgrades over probably about 2.5 or 3 years, bringing us to where we are today. In my opinion, that downgrading reflects the sentiment of international stakeholders who are not convinced about the sustainability of our policies, rather than being convinced about cash flow management. We hear from time to time various policy makers saying, no, we are managing our foreign exchange by managing cash flow. But if that belief was, I think, factored in, then we won't be in this situation, because I'm still not. I feel that that's not been properly accepted. That's why we are seeing this downgrade still where it is. And of course, when that currently happens, downgrade happens, and I have spoken to a number of bankers informally before I came onto this audience. What has happened probably in the past 1 year is each bank has, through a whole series of foreign correspondence, counterparty limits, both for funding purposes, for purposes of taking loans, as well as non-funded lines for letters of credit, confirmations, and various things. What has happened, I think, in the past year or so, with this downgrading and the perception the markets are having, the counterparty lines literally from every foreign correspondent has been trimmed or chopped, both in terms of size or value on one side, and secondly, in terms of tenor or period. So, for example, if a confirmation line was given, say, for 18 months, it's now down to probably 12 months or 9 months. So, that is also further causing this frustration about the banks, their own ability to support the demand for dollars or dollar-based, currency-based support from importers and or customers. So that is something we have got to realize on one side. Then when this happens, something else is also happening. It is not correct to, I know we did have a challenge in terms of exports because of first the April 2019 and then the double whammy of COVID. But if we really looking at the numbers which came out, I think the external data which came out as at June, and again, if I am making any mistakes on numbers, Deshar will probably correct me. I'm told that the year on year, as at June, the exports have actually seen a gradual growth. It's approximately 12.6%. And we have actually seen from January to June, the export quantum is 5.6 billion against 4.4 billion for the same 6 months period of 2020. So we have actually seen a progress on one side. The second, of course, on the other side, we have also seen imports ballooning. So there is obviously a deficit. But parking the deficit aside, while these exports are there, the question is how much of that is actually being converted by exporters into rupees in banks, because unless there's no point in those dollars remaining in banks in an FCBO or a BFCA account, the banks will not be able to make use of those dollars to support an importer if they are not able to buy those dollars, right? So what is obviously happening is, with this perception, this maybe this also this concern about the ratings, exporters are probably anticipating a devaluation like what they did a few years ago, and they are probably holding on to this. Point one. Secondly, when you are holding on to it, unlike when they held on to it a few years ago, the domestic interest rates were double digit. So when they needed to convert for local expenses, they had a challenge. But today that challenge is less of a problem, because our policy rates, the rupee rates, have also come down to significantly single digit. And for some of the good, strong exporters, they are actually able to generate money today at literally PLR. Some are even generating at less than PLR, right? And they are able to get on a typical 12-month FD anything 5 to 5.5%. And some of them are able to place it on 9 months Sri Lanka development bonds at rates at as high as 7%. So on one side, the guys are keeping their dollars and getting a good yield. On the other side, they are also keeping their dollars and against their dollars able to generate rupees at incredibly low rates. So that itself is not helping the overall system. Our importers on one side, the young students who want to send money outside, somebody who has a health issue who wants to send out some money outside for health. I mean, there are a whole not only importers, guys who have to send the outward TTs are having a problem. Then in that context, in the middle of that, we then have, while we spoke about this central bank rate, Faisal, I would like to make a correction respectfully. I don't think, as far as I am aware, the regulator, central bank has officially published the base rate. I think what they are doing is they are meeting these banks every day or very frequently, and there is a gentleman's understanding about a particular rate. But the rate is not published in any directive, so there's no directive, right? But I would call it moral suasion. So when you have that literally 200 rupees on one side, and there is a supply demand mismatch between the stock of dollars on one side, the demand for dollars, and then exporters anticipating a depreciation, naturally there was a gradual free for all where this informal gentleman's agreement slowly started to collapse. And what you saw yesterday and today was literally a total collapse when it went to that 208 or 210 level on the official buy side. On the sell side, it's heading as high as 215 today. Of course, the curb market, or we call curb market today, the cash market went up to 238 rupees today. I checked in the market today, it was 238. Now, that is also telling me on one side, exporters are reigning. They are commanding on one side. The second thing we have to bear in mind is inward remittances. While inward remittances, the average, the common poor fellow who is bringing $1,000 is getting that 197 or 198 rate. That's reality. But you must understand there is a whole series of money changes. If you go on the Vellavatta High Street, you will see, as an example, there is a whole series of money changes. Now, there's a parallel market going on. They are willing to offer for cash anything close to 230, 235 because they are able to use those dollars for any poor student who wants to take $3,000 or $5,000 out in the market where he can't go to a bank. He's willing to pay even $240 to get that dollar. So there is a parallel market taking place, which unfortunately, to a great extent, is being augmented because of this three-tiered structure which is taking place. So we have got to understand that it is supply and demand. I mean, as somebody recently put on Twitter, market prevails. You can't force suasion. As an example, today, while one big state bank on the website showed 197 rupees and 75 cents for buying dollars, I saw in three other banks 216.75, 213, 206.50, and a foreign bank showed 207.43. So you can see the various divergences. Literally, it's becoming a free fall. So that's on one side. Then on the other side, is there really a shortfall of dollars? In my humble opinion, I don't think there is really shortfall in dollars because part of that surplus, two things have happened. Some of those who have the firepower and don't need to borrow so much are actually deploying those dollars into Sri Lanka development bonds and ISBs and earning a much higher yield. So when they are locking that money into ISBs and SLDBs, that is sucking up that amount of dollar liquidity from the market necessary to finance trade finance. So that is also creating a sort of a shortfall on the trade finance, but it is created because of this particular reason. And the final point I want to make is there is the market, the banking market, the foreign exchange market is not with NBFIs, it's really with banks. And if you look at the banks, there isn't a unanimity or a synchronization with every bank to say there is a balance between the amount of imports they finance and the amount of exports they finance. No two banks are the same finger. Now, I know, for example, while the two big state banks typically will finance, if you look at, say, oil, for example, each of them will look at least 50% of the oil bills they will finance. Now, one of those state banks has about 40% of the inward remittance market and a reasonably high export base. But the other state bank is predominantly import driven. They don't have that amount of exports. Similarly, among the local private banks, you will have at least one large private listed bank which is exporter heavy, whereas 3 or 4 of the other well-managed private banks, listed banks, are importer heavy. So when the likes of Shankar or somebody goes and says, I want my dollars, there was a time when the interbank market worked. The guy who was short of dollars will go to the guy who has long on dollars. They will then go into the intermarket and interbank and do what they call a interbank swap. But that is, even that market has disappeared now because the benchmark is that guideline which has been given now from Janadipati Mahawata. So when that is happening, the guy who is long on dollars and who doesn't have a need for imports is also saying, why should I do that? And he's holding on to that. While the guy who needs the dollars is suffering. So as a result of that, what is happening? Effectively, de facto rationing is happening. And I'm not going to be disrespectful to any of my banking colleagues, but in reality, what is happening is when rationing takes place, you have to dish out on some sort of priority. And naturally, each bank will first look at supporting their own customers before trying to encourage any other customer from another bank who has been directed by another bank. So that is reality. We have got to accept that. So frankly, until and unless there is a policy consistency message which goes out into the international community, that there is a very clearly readable policy consistency from an economic perspective and a monetary policy perspective, which gives them the comfort to read that and then re-rate us. We will continue to, in my humble opinion, there is no shortcut for this. Frankly, there is no shortcut for this. Those are my initial thoughts, Faisal. I will take as many questions as possible.
Thank you, Tyagi, for that overview. When you spoke about the rationing of, I think, LCs, my mind goes back to the 1960s when we grew up with rice ration cards. For us who were living in that generation, the only rationing was rice rations. Coming back to today's topic.
Just sorry, if I can just correct. Well, yes, rice session, we knew of rice session, but when we were training as accountants, I can tell you when I started my banking career with Chase, I can tell you 2 countries which were rationing currency. Zambia was rationing currency for any chartered accountant who worked there. They used to wait in a queue to get their dollars out. And the other country was actually Jamaica. When Michael Manley devalued the rupee in 1974, there was rationing. So we're not the only country, but unfortunately we are at the wrong time.
Yes. Thank you, Tyagi. Thank you for that overview on from a banking perspective on the foreign exchange crisis. Just to state again that the chat box is there for those of you who like to ask questions, and preferably with your name when you pose a question. For our next topic speaker, we have Mr. Deshal Dimel, who will talk on the foreign exchange crisis and the impact on the economy. Over to you, Deshal.
Thank you. Thanks a lot. Can I be heard?
Yeah.
Fantastic. Super. So it's always a tough act to follow Mr. Tyagaraja, who laid out really clearly the ground situation with regard to the manifestations of the foreign exchange situation right now, and how it's in fact impacting the banking sector. So I'm going to take a slightly more macro perspective. I'll probably start by talking through some thoughts with regard to the origins of this of the crisis situation, which will also help us then understand the possible solutions and the way out of it. And I'm glad to note that Mr. Tyagaraja's final notes were pretty much in line with what I will conclude as well. But let's go to the beginning of this story. So Sri Lanka in 2020, like a number of other countries, had a sharp increase in its budget deficit, right? The fiscal position deteriorated quite a bit. For two reasons. The first was the policy choice to reduce taxes in December 2019, but also the impact of the pandemic on economic activity and therefore overall tax collection. The way that Sri Lanka was different from other countries was that our starting position was also weak. So we entered the crisis with an already weak fiscal position, and this pushed us into a much more adverse position. So we ended 2020 with a budget deficit of 14% of GDP, which is the highest that Sri Lanka has had since 1987. Now, with this, we saw the acceleration of our rating downgrades. Mr. Tyagaraja is correct in that we have had rating downgrades in November 2018, December or November 2019, but we were at a B level even at that point, but we went to a triple C level, I think only in 2020, when the real manifestations of the fiscal deficit started to really show. So with this credit downgrade to a triple C level, it really locks Sri Lanka out of most of the global capital markets. So our ability to raise financing overseas, to A, finance the budget deficit, and B, to be able to refinance the maturing ISPs and the maturing debt, that basically went out the window. So most of then what happened was all of the financing of the budget deficit had to come from the domestic sector. Now, we all know that when you have a large budget deficit and all of that is financed from the domestic sector, typically that would cause interest rates to go up very sharply. But what has, so the Sri Lankan government made a conscious decision to not allow interest rates to go up sharply. And to prevent that, what happened was the central bank stepped in to directly finance part of the budget deficit. And that is what we call deficit financing. Very loosely, in layman's term, we would refer to it as money printing. But deficit financing is the word that I prefer. So in 2020, the government was able to finance this large 14% budget deficit whilst keeping interest rates at a moderate level, because the central bank stepped in with a large amount of deficit financing to support the government's budget financing requirements. Now, during that year, when the economy was in recession, this significant increase in money supply, in liquidity, didn't really have any adverse impacts on the overall economy, because when an economy is in recession, the private demand for credit is very low, overall economic activity is weak. So it's possible for that large increase in government demand for credit to take place without really having any triggering pressure for inflation or triggering pressure for the currency to depreciate because of the widening current account deficit of the balance of payments. So 2020, we were pretty much okay. Now, ironically, the problems will start to emerge in terms of macroeconomic stability when the economy starts to recover. So what we've seen since the fourth quarter of 2020 was that when we saw the economy starting to open up, private sector demand for credit also started increasing. So now we've seen since around December last year, a fairly substantial, actually since around September last year, a fairly significant month-on-month growth in private sector credit in the economy as well. So now we have two avenues of credit creation. From the government side, there is demand for credit, as well as from the private sector side. So that means now you're starting to see a significant growth in overall money creation in the economy. Now, typically what happens in Sri Lanka and in most countries is that when you have these large increases in money supply, that starts and in liquidity, that starts to get loaned out to the rest of the economy. Now, in Sri Lanka, what we see is that typically there's a strong import component of economic activity. So approximately 80% of Sri Lanka's imports are intermediate goods and capital goods that are required in the production process. So once you start to see the economic activity taking place, loans going out, companies expanding, working capital being used, that starts to pull in imports. And from the first half of, also from like the second quarter of this year, we've started to see that really starting to that manifest really in the in terms of import demand increasing, resulting in the current account deficit of the balance of payment widening, and that starts to put pressure on reserves as well. So if we take ourselves back to December 2020, we had forex reserves of about 5.6 billion US dollars. Even by the end of June, before the ISP settlement in July, we had the reserves had come down to about $4 billion. So even before the big payments, we had about $1.6 billion worth of reserves going out, mainly because of the settlements, because of the widening current account deficit. Now, a lot of people have wondered, okay, we've been having these import restrictions. How come that hasn't really had much of an impact? Because as Mr. Thiagat also said, imports have expanded quite significantly in the first half of this year. And there are two factors. One is the rise in commodity prices globally. So with the global economy also recovering, we've seen oil prices going up from an average of $42 per barrel last year to around $70 a barrel today. And at the same time, with that growth in lending, the excess liquidity being loaned out, we've seen the volume side also demand for imports have picked up. And people have also wondered, so does that mean that Sri Lanka imports too much? And I would argue no, because if you take as a percentage of GDP, Sri Lanka's imports account for about 25% of GDP. Whereas we take a country like the Philippines would be around 33% of GDP. Thailand, imports would account for about 37% of GDP. Malaysia, 55%. Vietnam, imports account for more than 100% of GDP, about 103%. Singapore imports account for about 144% of GDP. So Sri Lanka's import content is not extraordinarily high. Our real issue is the fact that our inflows are quite weak in terms of exports, in terms of remittances. All of that is not really sufficient. And that is really where the kind of structural fundamental issue has been. So with this, recovery of economic activity, recovery of loan growth, liquidity starting to get loaned out, we've seen reserves coming down. And with the repayment of the ISB in July 2021, as Mr. Thiagat quite rightly said, reserves came down to $2.8 billion, which is around 1.7 months worth of import coverage. Now, the good thing is that in the latter part of this month, we will get $780 million from the IMF as a SDR that goes out to all of the member countries. And that will help keep our reserves probably from my calculations, between $2.5 billion to $3 billion by the end of this year. The issue, though, is that the problems don't end this year. In 2022 as well, we have about $5 billion worth of sovereign liabilities that mature that need to be settled, and similar amounts between $4 billion and $5 billion in every year for the next 5 years. So our real problem is that we have reserves at this low level of $2.8 billion. And at the same time, we have recurring large maturities of sovereign debt. Now, it is in order to kind of preserve these reserves at this limited level that the government has imposed all these measures to try to restrict imports, to restrict the types of payments that can be used to settle imports, and all of that. And that is really where this crunch has really been taking place. So, what is the solution? Now, a lot of people think that, look, when tourism comes back on track, whether it's in 2022 or further down the line, that that will solve a lot of our problems. But the issue is that even with tourism, Sri Lanka still has always run current account deficits in the balance of payments, right? So if we take 2018, that was the year, Sri Lanka's best year in terms of tourism earnings. We had $4.3 billion in 2018. But in that year, we ran a current account deficit of 3.2% of GDP, which was the highest current account deficit, say, in the last 5 years. So tourism alone is not going to be enough to really solve our problems. The way to, on a sustained basis, to be able to get out of the situation, to improve our dollar liquidity, is, as Mr. Thiagaraj also said, to regain the confidence of global markets. And that requires a way that we re-rate our credit ratings from a CCC levels back up into the Bs and keep increasing it from there. Now, the issue for that is we do need to have a credible plan that addresses our fiscal issues, where how we get from a 14% budget deficit down to say 6 or 7% budget deficit in the short term, and then bring it down to around 5% in the medium term. We need a credible plan that outlines that. And thus far, we haven't had that. So it is really when you have a credible plan like that, that is able to then convince markets that, look, these guys have got a way of getting back on track. We are happy to lend to them, and then that will basically enable us to raise foreign capital to roll over these maturing liabilities, and then give us enough space to be able to address those fundamental issues. Now, a lot of people ask the question, look, do we need the IMF? What is more important is that plan. If you have a plan that you can convince the markets that, look, this is a workable plan, it's credible without the IMF, then that's good enough. But the problem for Sri Lanka is that we have struggled to do that over the years. We have not been able to convince global markets that we have a credible policy framework in place without having an institution like the IMF to back us up. So that IMF really acts as an external anchor of that credibility. With regard to the IMF, it's not really the money that becomes significant. The amount of money that is provided by the IMF is relatively small. But what it does, it provides a signal of credibility to global markets that a country that has a program has a workable, sustainable policy framework that markets can believe in. So really, the question is, it's not a question of whether we need the IMF or not. The question is whether we have a plan or not. And that is really what we are, I think, all still waiting to see. Okay, let me end there. Happy to take any questions.
Thank you, Desha, for that comprehensive overview on the economic side. There are a few questions that have come in on the chat box. I would also like to add, I'll take the first two questions. I'll pose the first two questions to our speakers. One is, why can't the central bank intervene in the market, right? And secondly, has the stamp duty on credit card use been increased informally by the banks, right? Those questions, and I'll also try to add one more, particularly to Desha. Now, our debt prepayments are going into the next 3 to 4 years, right? When we have ISBs and so on that we have to repay. If the IMF doesn't come in and give that confidence to the international community, will we have a situation that prevails now even the next year, right? Even in 2022. Tyagi, will you answer the first two questions, and then I will move on to Desha?
Yeah, I think Chandra had posed two questions. I had already responded to one on chat. Yeah. On the stamp duty issue, I am just getting that clarified during the session. I will clarify it, because as far as I am aware of at least 1 or 2 banks having increased that 2.5% or whatever it is to 8%. But let me, before the end of this session, get it cleared whether it was an industry-wide initiative or each bank is doing something. So please bear with me for the next few minutes on that. The other issue was whether the central bank should intervene, right? My personal view is that is not a sustainable thing, because the way we are today, the central bank does not, as far as I am aware, they do not have the firepower to do so, because even Desha will either validate or correct me, of that 2.7 billion what is there today, I think there is about 400 million which is gold, which is not readily liquid. It has to get converted at some stage. So what is realizable is about 2.5, right? And the more, and with the current account deficit at the moment, currently, as far as I'm aware, the June-July numbers showed about 650 million of export, no, almost 1 billion of exports came in, but the deficit net imports was 652 million. once you offset that against the inward remittance, which was about 500 million, there was about 150 million still net shortage, which would have been draining the reserves. So if you start to go at intervene, you are going to go deeper into that limited pot of reserves you have, and it is not a sustainable thing. You can do that when you have deep pockets, but today when you're, frankly, no. And I don't know whether in a situation where we are downgraded, whether the markets will respond positively to that sort of thing, because they will also see that it is a unsustainable initiative. That's my personal view.
Desha?
Yeah, I mean, before I go on to your question, I fully agree with what Mr. Tyagaraja just said. When you have reserves at 2.8, 2.7, $2.8 billion and the known outflows over the next, the short to medium term is as high as it is, it would be pretty suicidal to sell those precious remaining reserves just to prop up the currency. So I fully agree that that is not a viable solution. In terms of the outlook for next year, so as I said, if you look at the inflows and the outflows over the next few months, so we do still have about $900 million worth of sovereign debt repayments on the regular multilateral and bilateral loans that we do on a regular basis, about $900 million more for the rest of this year. We do have the inflow from the SDR, and some of the swaps that have been spoken about are likely to materialize as well. All that taken into account, we'll probably end the year with around $2.5 to $3 billion worth of reserves. But next year, in January, we have another $500 million ISP that needs to be settled. We have about $700 million worth of SLDBs that would also mature in January and February next year, in those 2 months. And then again in July, we have another $1 billion ISP that needs to be paid. So really, without that, we can't really carry on as is without getting that new sources of external financing to come in on a sustained and regular basis. So we can have situations where we'd have, a swap coming in here, a small bilateral loan coming in there, but that is basically kicking the can down the road. The really sustainable way to fix this is to regain access to that line of credit that we can raise from global capital markets. Without that, it's just kicking the can down the road, and we're going to in that scenario, kicking the can down the road, we will continue to have these restrictions on imports, restrictions on payments. It will be very difficult for the operating environment. I mean, the speaker who spoke first quite clearly articulated the difficulties that we have for the economy to run within these kind of constraints. So kicking the can down the road is just going to prolong that. So unless we are able to regain access to global capital markets, we won't have a viable solution to this.
Asoka, has your query on IMF being addressed sufficiently, or would you like to seek a clarification?
Well, maybe just sort of very briefly, maybe I would just ask whether in light of so many people speaking about the IMF these days. And actually, I think it's Deshal who had mentioned this to me many years ago on this whole thing around this signaling effect of the IMF program to the bond markets. I mean, should we just not be even talking about the IMF right now in light of the downgrade?
Desha?
I don't agree on that, Ashoka. I will take that, and maybe I personally feel, as Deshal said, it's a confidence, the great confidence builder, especially when we are out of the markets. To get into the markets, the market will also look at something to grasp, and a stable multilateral like IMF will certainly send positive signals. And I'm sure Deshal will reinforce this. If you look at the past 20 years, we have at least gone on this route twice. And we have, of course, you have to take a bit of a bitter pill, and what they say, straitjacketing. But this straitjacketing is like, I mean, frankly, if you today go to a bank and say, I want a bit of relief on a loan which I have taken, and I want yourself to help you to restructure it, no bank is going to open-endedly do that without putting some strictures in. So it is the same thing. It's only a question of negotiating article and getting, I mean, we have seen this in the past, at least during my involvement with the Ceylon Chamber in the last 10 years, I have seen this twice. And I have seen how, I mean, it's a give and take. It's a give and take. Eventually, I mean, they will come down pretty hard, but as long as you're also consistent in your case, it ends up with a win-win. But of course, after that is done, there's a monitoring process. It's like any other financial institution today who will agree to give you a relief but monitor. There's a monitoring process.
There is a question. Okay, Chandra has asked a question. I'm just reading from his query. On an accurate assessment of the fiscal gap as of today, will it not reveal that the issue at hand on today's part is a negative solvency issue and not a short-term cash flow issue? Tyagi, will you be able to respond that, or Desha?
As I said, I mean, see, the markets are not reading cash flow. Markets are probably looking at how they interpret solvency as well as sustainability in policies and actions in resolving it. If not, we won't be talking there. I don't know, Deshal, what do you think?
So it's an interesting question. I mean, solvency, as we know it, it's very different from a sovereign's perspective versus the company, right? For a company, we know very easily look at the balance sheet. You look at your short-term assets, your short-term liabilities. If there is a significant mismatch, you can tell that there is a clear solvency issue. But for sovereigns, you don't have that, right? You don't have a situation, you don't have assets and liabilities that you can clearly trade off like that. So the definition of solvency from a sovereign perspective is actually quite vague. It looks at some measures of future of the number of future primary surpluses and the present value of that and how that matches up against your liabilities. But it's not a concrete number or a concrete concept like what we have when assessing the solvency of a corporate. So in that sense, I mean, even if you look back to when we had an IMF program, we had access to capital markets in, say, 2019. At that time, the situation wasn't very rosy either, right? We had a 6.8% budget deficit. We had a GDP of over 85%. But somehow markets were lending to us. So really, I find it quite problematic to speak about solvency when it comes to a sovereign. I think what is important is whether you are able to find a situation where you can stabilize your debt and then establish a mechanism or a credible path towards basically reducing your debt over time. But to say that, I know that there are people who take a stand on this, but I find it difficult to say that Sri Lanka is insolvent because it's hard to define, right? So I would worry more about the kind of path out of the situation right now, how we regain that confidence through global markets. And so, but I mean, what is abundantly clear is that we do have a huge issue in terms of liquidity. There is a clear liquidity problem. But I would hesitate before extrapolating from that into calling it a solvency problem as well, given the difficulties around defining solvency from a sovereign perspective.
Thank you, Desha. I think Mr. Tyagaraja also discussed it during his presentation, but there's a big problem about students who are studying abroad, and parents are finding it difficult to get dollars or foreign exchange for their children. So some of them are compelled to go to the parallel market. But Tyagi, can the parallel market be able to cater to this large source?
You see, as I said, when people are getting 230, I mean, today I checked with somebody in the market, it was 238 rupees at about 3 o'clock. Right? So guys who are having dollars in the hand, the inward TT was getting 235 today. And sorry, the cash was at 231. So when that sort of pricing is given, who is going to go to a bank when they have that sort of premium? So these guys are now getting their hands on to that sort of dollars or GBP. So when that is there, why would they have a problem? Because here we are not talking about $1 billion oil LC settlement. We are talking about typically $3,000, $5,000 people taking and going. So I think serving those people, I'm sure that that parallel market will be able to be served, but it's very sad to see that happening when healthcare and education are two very, very important segments, which I think the formalized banking system should support. But unfortunately, because of this mismatch in the system, these guys are compelled to go. Now, I am because I also act as a chairman of a higher education institution. In that particular institution, we have this program called Study Abroad or Send Abroad. Now there are about 40 guys going to Belarus to study medicine. And each of them was, I mean, while the remittance is going direct for the fees, for visa entrance into the country, they need to take $3,000 each and go. And they were running everywhere in the market for the past 3 days, trying to get this $3,000. And eventually, I think they ended up in the curb. So that's very sad. Just to respond to Chandra's question on that stamp duty, I just got an answer from one of my former colleagues. It's not a revision in stamp duty, Chandra. What they are now doing is, I believe some of these banks have increased what they call commission on FX for FX related transactions, ranging from 5% to 8%, which used to be around 2.5%. I believe they have started to increase that now.
Thank you.
I hope that.
Yeah, thank you. There are no more questions on the chat box. Is there anyone else who would like to ask a question among our audience today? Sampath? You can unmute and ask questions. Sampath, you have anything to ask?
I'm fine. We'll forward to our members if there's anyone who's interested to ask
anyone about from the Sunday Time Business Club members or even the members of the public who have joined us today. You can ask. We have some more time to ask questions and get a response.
Hello.
Vinny, would you like to ask a question? I see you have unmuted yourself.
Yeah, I just want to know why the government can't give a higher rate for this PFCA account holders. Then they will convert their dollars, and the government is getting dollars also. And also, the government can say you are emitting that they will give a special rate.
Tyagi?
Yeah, let me take that. So as I said, I presume you were talking about the BFCA accounts, right?
Yeah.
So as I said, for the BFCA account, when the money is coming in, the private banks are already offering. They are already offering rates. I mean, when this benchmark was set at 198.
No, even I want. Yeah, sorry, Mr. Tiara. Even I want to convert today $5,000. They said they can't because of this central bank ruling.
Central bank is not. I want to correct. You can tell whoever told you that central bank has not given any directive to any bank. It is only by understanding. A gentleman, there is nothing put in writing there, right? That's why you are today having. I quoted the rates today. What banks were giving today? Actually, if I can repeat that, I can tell you 207.43, 206.5, 213, 216.75. These were the rates which came to me this morning between 10 in the morning and midday.
Even
So
yesterday
even though the websites may be quoting something, in actual fact, these were the rates I got this morning, right?
when I tried today, and also still for the FDs, or you, if you have a PFCA account and you have a foreign currency deposit, that's also they have given a ceiling rate, central bank, not more than 5%.
So you got to understand in fairness, see what is LIBOR today? LIBOR is below 1% today, right? And when, I mean, we are in the market, I mean, with all due respect, I mean, I have got colleagues, friends and relatives who are in the UK today who are getting 0.1% for their dollars. In Singapore, I think if it's less than $1 million, you get zero interest. I mean, we are in this country, you're actually getting 5.5%. What more do you expect to banks to pay on a dollar? Because you got to understand when that you are paying 5.5 or 6 or 7%, somebody has to take that money and deploy it, right? When you are deploying it, then you are entering into a different conversation on interest rates. Now, for whatever reason, rightly or wrongly, the government took a decision over the last 18 months or so, and they brought down the policy rates to single digit. Now, while that is obviously may not be to the satisfaction of people who have dollars or even savings and even pensioners, even from the rupee side, it has helped entrepreneurs and businesses on the other side to make their businesses a bit more viable. So the question is whether the government can actually do something to please everybody in the ecosystem. You know, in that game, at any given time, somebody will have to pay the price. And I think what we were when we were at a double-digit domestic interest rate regime to promote economic activity, it was believed that it will be in the best interest of the country if we brought it down to affordability. And now, okay, it has come down. Now the question is, has it come down too much? And in that process, is it actually now rebounding back? So the question is, it's never too late for these rates to be revisited from a policy perspective, and a suitable adjustment to be taken. That's why you have a monetary policy consultative committee to be able to look at the two sides and seeing, okay, now that the ball has shifted, has it over tilted, and how to tilt it back? That's a policy dialogue.
Interestingly, the central bank is having a press conference tomorrow on the monetary policy. I think the monetary board would have met today, and they will announce their policy tomorrow. So some idea of how the central bank is looking at this first way will emerge at this meeting. We have there is a question here saying question. Raj, would you like to ask the question? Unmute yourself and ask the question. I can't fathom what you're saying here. Raj?
Yes, Faisal. So, can you hear me?
Yeah, yes, we can hear you.
Okay, Faisal. So the question was, I think either Deshalo Tyagaraja can actually explain this. Now, what a common man says is that we are taking more and more loans from China, as well as today there is a loan from Bangladesh and all. So what a common man says is that we are getting more loans to cover up the issues that we have in Sri Lanka, and to whether it will also bring back the dollar to the previous value of 200 rupees. Is it what that it's going to happen, or what is the problem? I mean, the solution to this problem?
Desha, would you like to respond?
Yeah, sure. So look, the reason why the government has to take some kind of external financing measures, be it bilateral loans or be it swaps, is to kind of bridge this gap that we see between these the liabilities that need to be settled and the reserves that we have at present. And given the fact that we run a current account deficit, and we have run a current account deficit for many years, we don't have the internal generation of dollars to be able to meet those liabilities and those outflows. So necessarily then from the financial account, you need to have some kind of inflow. So that inflow, I mean, ideally you would want that inflow to be in the form of something like FDI, which is then a non-debt creating inflow. But of course, those take time to materialize, right? You're not going to get the kind of volume of FDI that we need to solve our problem over the next year or two. That takes a long time. It needs to build, that also needs to have confidence built to kind of generate that kind of volume. In the interim, you will necessarily have to have some kind of financing, whether it's from a bilateral partner or whether it's from a swap or whether it's from an ISB or from the commercial market. Now, what's happened to Sri Lanka is that we've lost access to that commercial market to be able to raise this financing. So we are relying on alternative measures like, the financing that has been given by China, the $1.2 billion from the China Development Bank that has come in now in 3 tranches. The recent swap that is being done with Bangladesh, the swap that's been negotiated with India, all of those are basically required to bridge this gap. And if it's not a loan from China or a swap from Bangladesh, it'll have to be from some other source. The fact of the matter is, we run these gaps between our current account deficits, our budget deficits. All of that has to be financed from somewhere. So really, the kind of longer term fundamental issues that we have is we have to find a way of managing our budget deficits over time. And that also in the context of recovering from a pandemic or still going through a pandemic, you can't do that overnight, right? You can't immediately shrink your budget deficit because that's going to kill growth. So you need to have a system that is sensitive to economic activity and to growth and livelihoods, whilst doing this over a measured period of time. But the long-term sustainable way of really addressing these issues in general is that management of the budget deficit, management of the current account deficits in ways that you're able to get longer-term non-debt creating inflows in a more sustainable, substantial manner. And that's not a overnight game, right? You can't just click your hands and have that coming in. That takes time. It needs to create an environment that builds confidence for investors to really bring that to be able to make those issues work. In the short term, this kind of bridging measure is necessarily going to have to take place.
If I can just add a couple of comments for the benefit of the viewers, while this talk is there about China and various borrowings, I think we need to also be mindful of something else. In the past, since 2007, in the past 14 years, the profile of our debt has changed significantly. Now, what we don't fail to forget is, if I just bring us back to say 1989, the total quantum of external debt to GDP was around 52%. But if we look at that 52%, I think somewhere around 2004, when that peace window took place, the quantum of commercial borrowings was a mere 2.5% of the total stock. The balance of it was all bilaterals, concessional credit. I recall when I came back from UK, France used to give massive, what they call French protocol, literally at 0% or 1%. Japan used to give at for 0.4% for 33 years or 0.33 for 40 years, right? So you had that sort of bilaterals, a lot of benevolence coming in until around 2007. And then, of course, with the end of the secession, when the GDP crossed that $4,000 at that stage, I think we lost that status of low income into what we call the lower middle income. And then all those concessional facilities arrangements one by one started to disappear because of the benchmarking. So naturally, the country had to turn to the international markets. And I think during Niwat Kabra's time, when he was the governor, he, I think, successfully led the first ISP of $500 million, if I'm not mistaken, around 2007 or 8. And I think there it was the right reason, because that time there was a lot of obviously euphoria on the reconstruction and development, even though in the first few years of post-war, the bulk of that growth may have come from infrastructure-led growth. I'm sure the intent would have been over a period of time following that initial phase of development, the competitiveness in terms of the export orientation. I mean, there would have been a plan over the next 5 to 7 years to rebalance the quality of GDP contribution. But then unfortunately, of course, nobody thought as to what would have happened in 2019. And certainly none of us would have ever envisaged in our lifetime that we'll see a pandemic in 20 or 21. So we are facing realities. And I think one needs to put that into perspective.
Thank you. We have some time more for questions. If anyone would like to ask a question, or we can wind up. Okay, so I'll move on to our business club secretary Samita to give the vote of thanks. Samita, over to you.
Chaturanga.
Chaturanga, you give the vote of thanks.
Yeah.
Chatur.
Faisal,
Yeah.
Chaturanga.
Chatu. We have lost Chatu.
He was here. Let me check. The line is. Yeah, he'll be. Give me a minute, Faisal. So he'll just had some technical issues. So he's working on it. He should be here within a minute. Chatu, it's.
Hello.
Yes.
Yeah, Chatu, go ahead.
Yeah, Chatu, go ahead.
Yeah. Can I start?
Yeah, please go ahead. Yes.
Okay. Thank you, Faisal. I think this is one of the most important topics that we have faced because the situation, and most of them are today interested in like together what's happening to this country, what's happening for the exports, for the imports, because since we have a shortage of foreign exchange. So I think today, Mr. Tyagaraja and Mr. Deshal, thank you very much. It was a very informative session. You all gave a very balanced picture, and we understand that it is something that we all should face today. But as a country, we all should face it together and come out together. And also, I think, Shankar, thank you very much because you triggered what the question and the real situation. You yourself being an importer, you know what are the hardships that you have faced. Thank you, Shankar. And thank you, Faisal, for moderating today's session. Thank you. Thanks a lot.
Thank you, everyone. And thank you once again to Deshal and Tyagi for your and Shankar. Thank you very much and good night.
Thank you very much. Thanks for the opportunity.
Thank you. Good night.
Thank you very much.
Thanks a lot.